In this video, I'm going to demonstrate how to immunize a bond or bond portfolio against interest rate risk. In our scenario, we need to have $1 million in 5 years to make a required payment on a contract. The money that we're going to have, the $1 million, to get the $1 million includes what we would get from investing in a bond, as in the par value at maturity, plus the reinvested dividends during the life of the bond. And in this spreadsheet, I have 4 different options for bonds. I have a 0 coupon bond, which has no coupon rate, a bond with a 5 years to maturity with a coupon rate of 6.7%, a bond with 7 years to maturity with a coupon rate of 6.99%, and then a bond with 15 years to maturity with a coupon rate of 5.9%. So what we're going to look at is how can we get a combination of bonds or the 0 coupon bond in the amount to give us $1 million guaranteed in 5 years as long as the bonds don't default. In other words, we're not eliminating default risk, we're eliminating interest rate risk. So I'm going to switch over here to a camera and just draw out for you the timeline of what we're looking at. So what we want is we want to invest money today at time 0, and in 5 years give myself more than enough room here. In 5 years have $1 million for some investment. Okay. So we're going to invest an amount down here. 5 years, we want our investment to be worth $1 million. And that can come in 2 forms. If we have a 0 coupon bond, we're just going to invest some money here. It's going to gain in value each year until we get to $1 million at time 5. With a coupon bond, we would invest some money up front, and then each year we're going to get a coupon payment and we get the cash, we have to do something with it. So we're going to reinvest it at the current yield to maturity to get $1 million at time 5. So just to work a quick example of this, going back to our spreadsheet, I'm going to go with bond 2 in this case because I want to demonstrate a principle here for you. So bond 2 has 7 years to maturity. It has a coupon rate of 6.99%. And it has a yield to maturity, and all these bonds currently have a yield to maturity of 6%. Then what we're going to do is find out what happens when we change that yield to maturity to 5%. So we want to know how much money we're going to have in 5 years if we invest in this bond. So we have the life of this bond is 7 years. We have time 1, we have time 2, we have time 3, we have time 4, we have time 5. I've given myself more than enough room here, time 6, and time 7. At time 5, we want to make sure we're going to have $1 million from this bond. So our coupon payment, our bonds have a face value of $1,000 each. So part of what we're going to do is figure out how many bonds we need to buy. And then each year we're going to receive, because our coupon rate is 6.99%, we're going to receive a coupon payment worth $69.90 every year for this bond. And then in year 7, we're going to receive $1,000, $69.90. Okay, so our face value of $1,000 plus $69.90. What we need to find out is how much is this bond going to be worth at time 5. So that's going to consist of 2 problems. One, a future value problem. So we want to know the future value of these cash flows reinvested for years 1 through 5. And then we want to find out the present value of these 2 cash flows at time 5, because that's what we can sell the bond for then. So we have a future value problem, we have a present value problem. So our first problem is a future value problem. So I'm going to go to my calculator here, and I'm going to clear everything. There we go. And I'm going to go to Apps, Finance, Time Value of Money Solver. I'm looking for the future value in this case. So my N is equal to 5 because I have 5 payments. My interest rate is 6 because that's my yield to maturity right now. My present value in this case is going to be 0. My payment is 69.9 because that's what I'm going to get every year. And I want to compute my future value. So I press alpha and solve. And it gives me negative 394.03. So my future value is equal to negative 394.03. Okay. So now I want to calculate the present value. So I have these 5 payments here. Now I'm going to take into account these 2 payments. So my N is equal to 2 because it's 2 payments past the 5 years. My interest rate is still 6. My present value is still 0. My payment is $69.90, so I get 2 of those. My future value is $1,000 because I'm going to get that at times 7. And now I want to calculate the present value. So alpha, solve, I get 1018.15. So the value of my bond 2, at time 5 is going to be the sum of my future value of all these reinvested dividends, and then the present value of these 2, because I can sell the bond at time 5 for $1,018.15. So my total value is going to be 8,121,441. So $1,412.18. So to find out how many bonds I need to buy in order to get there, well, I need $1 million in 5 years. And each of these bonds, if the yield to maturity doesn't change, I will have in value from purchasing this bond $1,412.18. Okay. So I need to purchase $1 million divided by $1,412.18. I'll need to purchase 708.125 bonds. And I'm going to show you how to do this in Excel too. So 708.125 bonds. If I purchase those today, the yield to maturity doesn't change, then I'm going to have $1 million at maturity, okay, or at 5 years. So now let's go back to the spreadsheet. In the spreadsheet, we're going to calculate all those things in Excel, and then we're going to calculate it as if the yield to maturity changes and figure it up for each, our 0 coupon bond, bond 1, bond 2, bond 3. Then I'm going to demonstrate how you can combine bonds to create portfolios that give us an even better outcome. So what we want to do first, let's go ahead and name these cells here. So I'm in B6. And B6 is the current yield to maturity. So I'm up here in the name box. I put in current YTM for the name here. And then in cell E6, I'm going to put in new YTM for the new yield to maturity there. I'm going to start down here with the value of the bond and reinvested coupon at the current yield, so the 6%, in 5 years. So to calculate the value of the bond and reinvested coupons at the current yield in 5 years, we're going to calculate the future value like I showed you on the paper and the present value as I showed you on the paper. So here I'm going to put in equals negative future value, and I put in negative future value because I'm going to put in positive cash flows, but I want my outcome to be positive, the value I'm going to get. So the rate is going to be the current yield to maturity, then comma, the number of periods is going to be 5, because in each case we're looking at the value in 5 years. Now for the zero coupon bond, it wouldn't matter. We could put in 5. For bond 1 we could put in 5, but then for bond 2 and bond 3 we get the wrong answer if we reference this cell here. So I put in MPER is 5, my payment is equal to my coupon rate multiplied by 1,000, because we're assuming the face value is 1,000 for the bond. The present value is equal to 0. And then my last option here is to determine whether it's going to be a annuity due or a regular annuity. All of these are regular annuities, so you would put a 0 here, or you could just put in nothing and leave off the last argument. So I've got my future value in there. Now I want to add in my present value, so plus negative present value. And the present value, the first argument is going to be the rate. Again, that's the current yield to maturity. The number of periods is going to be my time to maturity in years minus 5. And if you go back and look at that timeline that I showed you, you'll see why. So if we have a 7 years to maturity, we would actually have 2 years left at time 5. In this case, we don't have any time left. So here it would just be 0. The payment is going to be 0, or I'm sorry, is going to be the coupon rate multiplied by 1,000, because for 2 of our bonds we do have payments that occur after time 5. And then our future value is $1,000. That's what we get at maturity. Then 0 for the type. And then you can see, oh, I need one more parentheses there. So you can see that's my equation. Press enter, I get $1,000. Exactly what I should get. I invest today at 6%, enough to get $1,000 at maturity. And then I'm going to show you here in a minute how to calculate the price of the bond today to get that $1,000. So I've got my equation in. If I've done everything right, I should be able to pull this over. And these are the answers that I get. These are correct. So bond 1, if we purchase bond 1, it would be, and the yield to maturity remained at 6%, we'd have $1,377.69 per bond. At maturity, bond 2, we'd have $1,412.18 at maturity, and then bond 3 is $1,325.23. The price of the bond today at the current yield. So here I'm going to put an equals negative present value. The rate is going to be my current yield to maturity, because that's what I'm looking for, is the price of the bond at the current yield to maturity. The number of periods is just going to be my time to maturity. My payment is my coupon rate multiplied by the number of, multiplied by 1,000. And my future value is 1,000. And then I can put in 0 here because it's a regular annuity. So the price of my bond today is $747.26. Again, I can pull this across. It's going to give me the price for each of my bonds today based on the current yield to maturity, the number of payments, the coupon payment, and $1,000 for the face value. The number of bonds I would need to purchase today, like I showed you on the paper, I would take $1 million, because that's what I need, divided by the value of the bonds. If the value remains at, or the yield to maturity remains at 6%. So I need to purchase 1,000 bonds, which makes sense. I get $1,000 in 5 years. I have to buy 1,000 bonds to get to $1 million. I'm just going to pull that over. And so if I just bought bond 1, I need to buy 725.86 of those bonds to get $1 million. I need to buy 708.12 bonds for bond 2 and 754.59 to have my $1 million in 5 years. So my invested amount, I'm in cell B9 would be equal to the number of bonds I need to purchase today multiplied by the price today. I get 747, 258.17 for the 0 coupon bond, the same for bond 1, the same for bond 2, and the same for bond 3. Let me explain why. So the yield to maturity on each of our bonds, we're making the assumption that it's 6%. In reality, the yield to maturity is probably going to be different for bond 2 and bond 3 at the very least, if not also bond 1, because there's different risk characteristics. And for bond 2 and 3, we also have a longer time to maturity. To keep things simple in this case, we're going to assume they all have the same yield to maturity, but you can fairly easily adjust that for different bonds. Because they have the same yield to maturity, they have the same returns. So if I invest 747, 258 and 17 cents for 5 years at 6%, I'll always end up with $1 million. Okay. We have 2 more rows to fill out here: the value per bond and reinvested coupons at the new yield to maturity. And it should say, what this means is this is the amount we're going to have in 5 years. We're assuming the yield to maturity changes to 5% in this case, from 6% to 5% the day after we buy our bonds. Okay. Because then we're going to reinvest. This is our reinvestment rate. We're going to reinvest our cash flows at 5%. So we're going to make the same calculation that we made in row 13, but we're going to, instead of use the current yield to maturity, we're going to use the new yield to maturity to make our calculation. So again, we started off negative future value. Our rate is now going to be the new yield to maturity. Our number of time periods is 5. Our payment is going to be equal to the coupon rate multiplied by 1,000. Our present value is 0 and our type is 0. And then I'm going to add to that negative present value, open parentheses. The rate is again the new yield to maturity. The number of payments is going to be the time to maturity minus 5. So again, because this is the present value of the stuff that happens after time 5, the present value at time 5 for those payments. The payment again is the coupon rate multiplied by 1,000. And then again, we're assuming that our bonds have a face value of $1,000. So our future value will also be 1,000. Our type is 0. And then press yes. So the correction that it made was I left off the last parentheses there, and it added it there for me. So I get $1,000. And you can again see the equation up here. And pull that across. And I want you to notice something here in a minute when we look at duration, but there is a difference between these values for each of our bonds. So for duration in Excel, we can type in duration. Calculating duration by hand can be a tedious process. Excel makes it somewhat easy. We need to make one little adjustment in here to make it work well for us. So we see down here that the commands for, or the variables for duration include settlement, maturity, coupon, yield. The yield and the coupon are the rates, not the dollar amounts. So we won't put in the dollar amount of the coupon, we'll put in the coupon rate. We'll put in the yield to maturity that we're using. The frequency is the number of payments per year. And then the lastly is the basis, which it has to do with how the bonds are quoted and priced. There's different ways to do that. We're just going to take the default route on that. But the settlement is the settlement date for a bond. So this is the date that the transaction is going to occur to buy the bond. So here we want to put in the command date. And you can use any year, month, or day. What we're interested in is having the time to maturity be the difference between those two time periods. So I'm going to keep it easy here. I'm going to put in the year 2000, day 1, month 1, close parentheses. So that's my settlement date. That's the date that we're actually going to purchase the bond. The maturity date is the date the bond matures. To make things a little easier on here, we can actually start with the year 2000. Plus, because we have an annual bond payment, we can take the time to maturity. If it were a semi-annual bond payment, we'd need to make another adjustment there. But in our example here, we're just going to use annual payments. So I can have $2,000 plus the time to maturity in years for our year. Our month is then going to be January. Our day is the 1st. So we have a 5-year period of time till maturity. In this case, 5 years here. This command will make it 7 years here for bond 2, and then 15 for bond 3. Now I put a comma in. I put in my coupon rate. It's 0%. My yield to maturity is going to be the 6% here. And then finally, the frequency is going to be 1 for annual. And then I'm just going to go with the default for the basis. So I put in 0 and then comma, and I get a duration of 5. And so this is a nice little check. The duration for a 0 coupon bond is its time to maturity. So we know this is correct. Okay, because the duration is equal to the time to maturity. For bond 1, the duration is 4.4198. And that makes sense too, because its time to maturity is 5 years. We know that a coupon, having a coupon payment, will decrease the duration of a bond. It decreases its interest rate risk. I'm going to pull this over again. I get 5.804 or 805, and again, its time to maturity is 7 years. The upward bound of the maturity or duration for a bond is its time to maturity. So this is below 7. And then finally, for bond 3, it's got a time to maturity of 15 years. It has a duration of 10.33 years. One thing I want to show you here is the effect of duration on the change in the price. And we're going to see this below too, but we see here that this bond has a duration, a lower duration, 4.42. And if we go from a 6% yield to maturity to a 5% yield to maturity, so our yield to maturity falls. So this was the value at time 5, 1,377.69. And this is the value if we change the yield to maturity. So for bonds with lower duration, the value, the future value of the cash flows and the value of the bond itself will fall with a decrease in the yield to maturity. And the future value of its coupon payments will fall with a decrease in the yield to maturity. Because that's what we saw here. This is an important point, because what happens is if the yield to maturity falls at time 5, if we had just invested in bond 1, we're not going to have $1 million. Okay, so what we would have, so if the yield to maturity falls from 6% to 5%, and we only own bond 1, we would have purchased 725.86 bonds, and we would end up with $994,579, which is close to what we want, but not enough. Okay, and if the bond rate would fall even more, or the yield to maturity would fall even more, let's say to 4%, we're going to be $11,000 short. So we don't want that. We want to make sure that we eliminate interest rate risk, and we're going to do that. I'm going to show you 2 different ways to do that here in a minute. For bonds with higher durations, the value of the bond and the future value of its coupon payments will fall with an increase in the yield to maturity. And what I mean by this statement is that it's the sum of the value of the bond and its future value of coupon payments, not individually that they'll both fall, but the sum of both. So let's go ahead and change the new yield to maturity here We start off with 6%. Let's change it to 8% and see what happens. So for bond 2, the value of each bond we purchased would have fallen from $1,412.18 to $1,392.06, and the value of our bond 3 would have fallen from $1,325.23 to $1,205.22. So what we would have had at maturity, or at the end of 5 years, for bond 2 would have been, we would have purchased 708.12 bonds, and we would have ended up with $753.30. And for bond 3, we would have ended up with $909,441.53. So we wouldn't want that outcome either. Okay, so we want to eliminate our interest rate risk. What we can do is combine our bonds with lower duration than the time when we need the money, and bonds with a duration greater than the time that we need the money, so in this case 5 years, to create a situation where no matter what happens with the interest rates, we'll always have $1 million at that time period when we need it, unless of course the bond defaults. But in terms of interest rate risk, we eliminate that risk. So that's what I'm going to demonstrate to you now. We wouldn't want to purchase any of the bond 1, 2, or 3 because of interest rate risk if we had to have $1 million in 5 years. But we can combine these bonds to get to something that will work for us. So the reason we do this, really 2 reasons. We could just buy zero coupon bonds. So as long as the bond doesn't default, it doesn't matter what happens to interest rates. A change in interest rates from the current yield to maturity won't have any effect because we don't have any cash flows between now and when we need the money in 5 years. However, we may not be able to find a zero coupon bond, or it may not be in a very attractive bond for us. There's many more options if we can explore other types of bonds. And so we can combine bonds and create portfolios of bonds that will eliminate our interest rate risk. So in the first case, we're going to create a bond portfolio of bond 1 and bond 2. And what I'm going to put in this cell here is just 0.5. And bond 2 is going to be equal to, the weight is going to be equal to 1 minus whatever I have in this bond 1. So our weights will always be summed to 1. Okay. So that's the key here. We want to put 1 minus whatever the weight is for bond 1. So the duration of our portfolio will be equal to the weight in bond 1 multiplied by the duration of bond 1 plus the weight in bond 2 multiplied by the duration of bond 2. Okay, and so if it's 50-50, we would have a duration of 5.11. What we want is a duration of 5. You can work this out by hand algebraically, and you're welcome to do that. However, I'm going to use Solver to do that for me. So I'm going to go to Data, and I have Solver up here, but if you don't, let me show you how to get there. I go to File and Options, Add-ins. Down here it says Excel Add-ins, so I'm going to go. And if this box is not selected, go ahead and select Solver Add-in, then press OK. So for Solver, I'm going to reset everything. So I want to set my objective, cell B23, to a value of 5 by changing the weight in bond 1, because that will change also the weight in bond 2. I want to make sure my unconstrained variables are non-negative, so I don't want a negative weight for bond 1. I'm going to solve. My solution says I should put 58.11% of my bond portfolio in bond 1 and 41.89% in bond 2. And that gives me a duration of 5. For portfolio 2, you'll see I have bond 1 and bond 3. We only have 2 portfolios because we don't want to mix bond 2 and bond 3, and that's because they both have a duration greater than 5. So we want our money in 5 years, so we want our bond portfolio to have a duration of 5. We can't get that with these 2 bonds unless we have a negative value or a negative weight for one of the bonds. So I'm going to put in here again 0.5 for bond 1, 1 minus 0.5 for bond 3, equals 1 minus the weight in bond 1 for bond 3. And then the duration is going to be equal to, for the portfolio, 0.5 multiplied by the duration of bond 1 plus the weight of bond 3 multiplied by the duration of bond 3. And I get 7.3739 for our duration. And again, we want 5, so I'm going to go to Solver. I'm going to reset everything. Yep. And set objective, cell B27, duration to a value of 5. By changing the variable, the weight in bond 1, press OK. And here we get 90.18% in bond 1 and 9.82% of our portfolio in bond 3. So now what I'm going to do is demonstrate the idea of convexity. So what we're going to do is calculate the ending values at time 5 for our investments in the zero coupon bond, in portfolio 1, and portfolio 2, with a change in the yield to maturity. So our options that I've put in here are 1% yield to maturity. So our yield to maturity would drop from 6% to 1%. So that's a very large change, up to 10% in the yield to maturity. And look at our different portfolio options to see which one will give us the best outcome. For the zero coupon bond, my ending value is going to be equal to the number of bonds I purchased multiplied by the value of the bond and reinvested coupons at the new yield to maturity in 5 years. So we're saying here the yield to maturity changes, and this is important that you choose this cell because we're going to change that new yield to maturity. So we get $1 million, and that's exactly what we want. We want $1 million there. So for portfolio 1, we're going to put that equal to the weight in bond 1 multiplied by the ending value per bond with the new yield to maturity multiplied by the number of those bonds we need to purchase today, plus the weight in bond 2 multiplied by the value we get at maturity if the yield to maturity changed, multiplied by the number of bonds we need to purchase for that bond. And we get $1,131.39. Then finally, for portfolio 2, we're going to do the same thing. We're going to take the weight of bond 1 multiplied by the value with the new yield to maturity and the number of bonds purchased today to get to our $1 million, plus the weight of bond 3 multiplied by the ending value with the new yield to maturity multiplied by the number of bonds we need to purchase there. And so in these cases we get a little bit more than $1 million, and you're going to see why that is here in a minute. But I'm going to change just to kind of check my own numbers here. I'm going to put this at 6%. And it should give me $1 million for each of my portfolios, and it does. So I'm happy with that. So now what I want to do, I'm going to highlight my table here, and I'm going to use what's called a data table. And what the data table will do is, because of how I set up my equations and referencing the new yield to maturity in each of these calculations, I'm going to tell Excel to replace that new yield to maturity with each one of these other yields to maturity. And then what it's going to produce for me is the ending value of that portfolio with that new yield to maturity. Okay. So I'm going to go to Data, and then What If Analysis, and then Data Table. And it gives me two options here, the row input cell or the column input cell. Now I can actually change two variables at a time using a data table, so I could change, for example, the time to maturity and the yield to maturity if I wanted to. I don't want to do that. I just want to change the yield to maturity. So I'm going to ignore the row input cell. We're just going to change one variable, and that's going to be the yield to maturity. So I go up here, and what I'm telling it is, okay, for every one of these calculations, change cell E6 to that number. Okay, the number we have here for the new yield to maturity. I press OK, and we get kind of the results I would expect. So with a 6% yield to maturity across the board, if nothing changes, we get $1 million. But if we look at our other two portfolios, and that's true for the zero coupon bond, across the board, get $1 million. For portfolio one though, a change in the yield to maturity actually benefits us because we're using two bonds of different durations to get a better outcome with a change in the interest rate. Same goes for portfolio two. In fact, we have a better outcome for portfolio two when we do that. So now I'm going to do, what I want to do is put this into a graph. So I'm going to highlight these because I don't want these included in my graph, this first number here. It's going to throw everything off. So I'm going to go to Format Cells. I highlight those, right-clicked, select Format Cells, go to Custom, and you can put in 2 semicolons here. And what that does, it just makes the numbers disappear. They're still in the cell, but you can't see them. Then the second thing I want to do is I'm going to go here, I'm going to right-click, I'm going to select Hide. So I want to hide that row 31. Then I'm going to highlight my table here, Insert, Charts, and I want to go to the Scatter Plot with Straight Lines. So do Quick Layout. Don't want that one. That one looks good. So my chart title is the new year, my axis title is the new yield to maturity. And my y-axis title is value of the portfolio in 5 years. Just going to take that out. So here's what a graph of my ending values with the new yield to maturity look like. With 0%, with no any change in the yield to maturity, my zero coupon bond gives me $1 million across the board. So there's no interest rate risk there. But again, like I said, we may not have a zero coupon bond available for that maturity, or it may be one that we don't, it may not be a bond that's attractive for us. So we could buy portfolio one, which is a combination of bonds 1 and 2, and for every yield to maturity that isn't 6%, we actually come out ahead. Okay. If we purchase portfolio 2, we even do better. So if we only get, the yield to maturity stays at 6%, we're fine. We have our $1 million in 5 years. But if it changes, we actually have a better outcome than that. And this curvature here, this sensitivity to an interest rate change, is referred to as convexity. So for our purposes, for this example here, the portfolio with the greatest convexity is portfolio 2, and it gives us the greatest outcome for our investment for any interest rate, yield to maturity. So again, we're investing the same amount. So our investment in these portfolios would also be 747, 258, 17. And choosing the portfolio with the greatest convexity gives us the best outcome. So we've immunized our portfolio. We avoid interest rate risk for any of our 3 choices here. I hope this has been helpful for you. Please let me know if you have any questions.